What's up guys, today we're going to be going over the 2022 model. This is the first model I like to teach students because it encapsulates everything from the 2022 ICT mentorship. All in all, this is just a very straightforward and solid model. I personally use this model a lot in my strategy, and yeah, I'm going to teach it to you guys now. I'm going to put a list of everything you need to know to use this model somewhere on the screen, so just take note of that before you start trying to learn this model. So what are the rules for this model? So the first thing is you want to look for liquidity to be taken out on a higher time frame chart than the one being used to view the model. So say we're viewing price action on the 15 minute. We want to see price take out obvious liquidity on the 1 hour or above. In this example, you can't see the liquidity, but you want it to be an obvious liquidity that the market is targeting. So you want that liquidity to be taken out, and that leads us to our next step. There should be a reversal after liquidity is taken with heavy displacement. So after liquidity is taken, there is a reversal with heavy displacement, meaning there is a lot of selling pressure, there's a lot of volume going one way. So this displacement should have created a market structure shift and left a fair value gap. So as you can see, we displaced and we left a fair value gap. So the next thing you want to do is draw a fib from the high that took liquidity to the low of the market structure shift. And if the fair value gap is above the 50% mark in a bearish scenario, then it is valid. If it is above or on the 50% mark. So price should come back into the fair value gap, and this is where you take your entry. So you can place your stop loss at this high, the one that took the higher time frame liquidity, and you can make your TP1 this level of liquidity created by the market structure shift. And then you can also target a lower intraday level of liquidity. I've seen people become profitable just off of using this and managing their risk wisely. And real quick, I just want to go into the actual reasoning of this model and explain it through reason rather than through visualization. So as we all know, the market targets liquidity so it can buy up all these orders, so it can get a better price. After that, it sells off because it is targeting another level of liquidity, which would be this right here. But we know the market leaves gaps and imbalances that it likes to use while reaching that objective. So in this scenario, it left a fair value gap, and that is what we use to enter internal range liquidity to external range liquidity. We know that market structure shifts are indicators of a change in price action, a change in the state of delivery, especially with heavy displacement. So we use this as our first sign, and then we see this fair value gap. And then we also know that the market likes to play with ranges. It likes to play with discount and premium. So it does this so it can sell at a better price. It doesn't want to just go all the way down to the sell side here. It wants to shift market structure, and then it wants to sell at a better price, which would be this imbalance. That is how the algorithm works, guys, you know? It is creating ways to split up orders and get the best prices possible for institutions to reach its objective. It operates on an algorithm, and this is just exploiting it to get the best entry possible. So one more time real quick, just so you guys can see it through the lens of the algorithm and the market makers. So we go up here to take this liquidity. What liquidity is really just resting orders. That's why it's called liquidity, because there's all this money here. After it takes this money, displaces down, shifts market structure, but it leaves a fair value gap, an imbalance. It also wants another fair price to trade at, a premium price to sell at to reach this objective. So it goes above this 50% mark into premium, and it goes here into this internal range liquidity level. So it is the perfect entry for institutions to sell and reach their objective, which is these resting orders. So here's a bullish example I took on YM. As you can see, we have sell side liquidity here. We took the liquidity and we actually came into a 15-minute BISI, which is an added layer of confluence. We came up, shifted market structure, and then we came into this fair value gap that was on the 50% level. And then we took a trade targeting this level of liquidity, and we actually ended up hitting this level of buy side liquidity. So there'll be more examples in the Discord, but I just want to say, if you need any help with this, just reach out to me. You know, you can just use this model and use a 1 to 2 risk to reward just about and be profitable with just this. This is literally all you need to be profitable, as well as the first model you will learn. It's super potent, it's super simple, it incorporates a lot of potent concepts into one cohesive model. It's really easy to understand and execute on, and it's really easy to form a strategy around this model.